the 3rd of January 2026. While most of the market was still half asleep after the New Year holiday, a rapid sequence of images flooded global headlines. A lightning raid in Caracas, special forces securing key assets of Venezuela's oil industry, and just hours later, President Donald Trump appearing at Mar-a-Lago, delivering a statement that made the financial world sit up straight. The United States had taken control of 50 million barrels of Venezuela's strategic crude oil. At the same time, confirmation came through. Nicolás Maduro had been arrested. A pro-Western interim government was installed in record time. And more importantly, the flow of crude oil that had been locked down for years was officially handed over to the U.S. and its strategic energy partners. If you're watching this video and think this is just another political news story, pause for a moment. Because for professional investors, this isn't about guns, protests, or ideology. This is the moment when money starts to change direction. And our job, as always, is to be standing in the right place when that flow accelerates. Let me ask you a very direct question. When was the last time you saw a country with more than 300 billion barrels of oil, the largest reserves on the planet, get unlocked in just a matter of days? The answer is never. That's why I call this a once-in-a-decade opportunity, perhaps even a once-in-a-generation event. Because what's happening isn't just a power shift inside Venezuela. It's a restructuring of the global energy map, followed by a repositioning of the international financial system. When Venezuelan oil returns to the free market, OPEC plus dynamics, energy supply chains, oil prices, bond yields, and even the status of the US dollar are all pulled into a new vortex. But remember this, the market doesn't pay the person who reads the news the fastest. The market pays the person who understands where that news sends the money. After more than 20 years working with large capital flows, I've learned one unchanging rule. Every geopolitical crisis creates at least one super profit cycle. The only question is, do you stand on the sidelines or do you prepare your portfolio to receive it? And no, in this video, I'm not going to debate who's right or wrong, who wins or loses on the political chessboard. I won't dive into tanks, warships, or diplomatic statements. I'm going to show you where the money is flowing, very specifically, very practically, and most importantly, how you, even as an individual investor, can still multiply your assets in 2026. Ask yourself one more question. When a country needs more than $100 billion to rebuild its energy sector from the ground up, who signs the contracts? Who sells the equipment? Who drills the wells? Who insures the risk? And who ultimately makes the biggest profits when the wheel starts turning? If you're curious, if you feel this isn't just news to be aware of, then you're in the right place. Up next, I'll take you straight into the first group, what I call energy reconstruction. The names may be familiar, but the opportunities are entirely new. And tell me in the comments, if you could choose only one sector to bet on in the first 6 months of 2026, which one would it be? As I told you earlier, money is changing direction. Now we go straight to the most important question for a true investor. Who will control the $100 billion needed to rebuild Venezuela's oil industry? Picture the reality. After years of sanctions, Venezuela's oil production system has become almost a zombie. Degraded wells, rusted pipelines, refineries operating at less than 30% capacity. To bring output back to a level that matters on the global energy map, there is no alternative but to inject massive capital, at least $100 billion, into upstream production, infrastructure, and technical services. And the investment rule here is very simple. Where reconstruction happens, outsized profits follow. 1. Upstream stocks, the giants. When a country reopens its oil sector, the first players to enter are always the giants companies with deep experience, advanced technology, and strong political connections. For me, this group represents stability plus controlled growth in a 2026 portfolio. Chevron needs little introduction. They don't just have production capacity, they are long-standing strategic partners in Latin America. In this new environment, Chevron acts like an energy bank, entering early, locking in long-term contracts, generating steady cash flow, and operating under policy protection. But the name that stands out even more in this cycle is ConocoPhillips. The reason is very clear and very financial. COP has a chance to recover $20, $30 billion in assets that were previously nationalized. Pause on that number for a moment. For an oil major, suddenly re-recognizing tens of billions of dollars in assets isn't just an accounting gain. It directly impacts valuation, future cash flows, and market confidence. If you were running a large fund, what would you do when you saw a company capable of reviving assets buried for years? You would buy, and you would buy fast. That's why a 20-30% upside in Q1 2026 for upstream stocks isn't wishful thinking, but a realistic scenario once institutional capital steps in. Let me ask you, do you prefer steady returns or a sharp re-rating driven by rewritten valuations? 2. Oilfield services, the builders. If upstream companies sign the contracts, oilfield service firms are the ones truly printing money. And this is where I call it by its real name, super profits. History makes this clear. After every war, after every reopening of supply, the biggest stock winners are often not the resource owners, but the companies that rebuild everything from scratch. Venezuela today doesn't need more promises. It needs drilling rigs, engineers, well repair crews, and a complete reconstruction of its infrastructure. Halliburton and SLB sit right at the center of this demand. Every new well drilled, every pipeline repaired, every field brought back online turns directly into revenue for them. These contracts are hard to replace, high margin, and often last for years. For individual investors, this is a rare chance to ride alongside institutional money while keeping growth leverage. When the cycle begins, the builders typically outperform the broader market, and more importantly, they move before earnings numbers show up in the headlines. Ask yourself, do you want to buy stocks after the media starts praising profits, or when contracts are still being signed quietly? 3. Tactical ETFs. Capture the cycle, reduce risk. I understand that not everyone wants or has the time to pick individual stocks. And in 2026, risk management matters as much as returns. That's where energy sector ETFs shine. The Energy Select Sector SPDR fund allows you to capture the entire U.S. energy recovery without betting everything on a single name. When capital flows back into oil and gas, this ETF acts like a wide net, collecting the benefits of the reconstruction cycle while helping you sleep better at night. The strategy is clear. Use ETFs as the foundation, then add a few high-conviction stocks to optimize returns. This isn't gambling. It's portfolio design for asset multiplication in a rare cycle. And before we move on, think about this. Once the sharks are full from stocks and oil contracts, what do they hunt next? The answer lies in a market few dare to touch, yet one that can deliver double or even triple returns. This is where sharks truly play the big game, the Venezuelan bond market. For years, Venezuelan government bonds were labeled junk, not because they lacked value, but because they were politically frozen. Sanctions, blocked payment channels, and legal uncertainty crushed prices to levels that scare ordinary investors. But for institutions, that's when buying begins. Today, many Venezuelan bonds trade around 30-40 cents on the dollar. What does that mean? You pay $30.40 to buy $100 of face value debt. Now connect that to the new context, a pro-U.S. interim government, oil flows reopening, and a very real path towards sanctions relief. If the U.S. fully lifts sanctions, what happens? No miracle required. Once repayment capacity is restored, bond prices can easily move back to 80-90 cents. That's 2x or even 3x returns, without leverage and without daily trading. That's why I call this the shark's game. Let me ask you this. How often do you see an asset with the potential to double or triple simply because of a policy shift? But the bond market is never one-dimensional. When Venezuela is unlocked, the world faces a second-order reaction, especially from geopolitical rivals. If BRICS countries, for strategic or retaliatory reasons, start selling U.S. treasuries, what happens? Treasury yields spike, and when yields rise, the entire global asset pricing structure shakes. For smart investors, this isn't pure risk. It's a capital flow signal. Big money always moves early and builds multiple layers of defense. On one side, they accumulate Venezuelan bonds at distressed levels. On the other, they reposition U.S. bond exposure to benefit from rising yields. So the real question is, how can an individual investor participate? I don't recommend buying individual Venezuelan bonds directly unless you have legal and liquidity expertise. A smarter path is exposure through distressed debt funds, vehicles that specialize in buying crisis state debt and profiting from turnarounds. This is the arena where major institutions have already been positioned for years. You can also benefit indirectly through U.S. financial institutions that hold or manage Venezuelan debt. When that debt is revalued, their balance sheets light up quickly and equity markets react fast. Let me ask you something very practical. If you held an asset considered junk yesterday but capable of becoming gold tomorrow, how long would you have the courage to hold it? Bond markets aren't for the impatient, but when the timing is right, their returns often make equities look tame. And here's the key insight. Once sharks move into bonds, they start preparing for the next worst-case scenario defending position against geopolitical counterattacks. That's when the story shifts from pure profit to protecting dominance. And in the next section, we'll talk about two classic tools that never go out of style: gold and the power of the U.S. dollar. After moving through energy stocks and the bond market where the sharks are quietly accumulating positions, the next question for a clear-headed investor is always this: what if the worst-case scenario plays out? If Russia, China, and other geopolitical rivals don't simply stand by and watch the USS reopen Venezuela, if retaliation appears across currency, trade, or military fronts, does your portfolio have enough armor to survive? I always tell my students one very clear principle: to multiply assets, you must first protect them. And in the highly volatile environment of 2026, there are three defensive pillars you simply cannot ignore: gold, defense, and the U.S. dollar. 1. Gold, the portfolio's mandatory insurance. Gold breaking above $4,400 per ounce isn't driven by euphoria, it's driven by fear. Fear of inflation returning as energy prices swing. Fear of currency wars as power blocks collide. And fear that trust in the current financial system is being eroded piece by piece. In every major geopolitical cycle, gold plays the role of the ultimate lifeboat. It doesn't generate cash flow, but it preserves purchasing power when everything else shakes. At this stage, gold is no longer a speculative asset. It's mandatory insurance for a 2026 portfolio. Ask yourself a very direct question. If equity markets corrected sharply in a single week due to escalating tensions, what would you want to hold so you could sleep at night? That's why I always recommend allocating a fixed portion of capital to gold, not to get rich fast, but to avoid getting poorer when shocks hit. 2. Defense stocks, profiting from government budgets. When geopolitics heats up, defense budgets are never cut. On the contrary, they tend to rise sharply and quickly. The U.S., increasing its military presence in Latin America to protect energy interests, brings a wave of new defense contracts from aircraft and radar to missiles and defense systems. Here, major defense contractors function like money printers powered by government spending. They aren't tied to consumer cycles, they're resilient to short-term recessions, and they often enjoy multi-year contracts. For investors in 2026, this sector offers both defense and steady growth. Psychology matters. When markets panic, smart money gravitates toward companies with a single but highly reliable customer: the government. That's exactly why defense stocks become indispensable in a defensive growth portfolio. Let me ask you, are you willing to make money from instability, or will you let instability take money from you? 3. U.S. dollar index, short-term safe haven waves. Finally, let's talk about the U.S. dollar. Despite endless criticism, in times of crisis, the world still runs to the dollar. As tensions rise, global capital seeks safety, and the DXY typically spikes on safe haven flows. The strategy here isn't to hold USD indefinitely at all costs, but to trade it tactically, using short-term stress to protect the portfolio and even generate additional returns. For flexible investors, the dollar acts like a breathing regulator for the portfolio. When risk rises, USD strengthens. When risk fades, capital rotates back into higher return assets. And here's the core insight. Gold preserves value, defense creates stable cash flow, and the dollar provides agility. Together, these three form the shield for an asset multiplication strategy in 2026. Before we move on, think about this and leave a comment. In an unstable world, do you prioritize defense first or offense? Because in the final section, I'll show you how to combine all these pieces into a precise capital allocation formula, one where risk is controlled, yet super profit opportunities remain fully intact. By now, I trust you've recognized an essential truth. The bigger the opportunity, the tighter risk must be managed. Asset multiplication doesn't come from all-in bets. It comes from building a portfolio structure smart enough to survive and accelerate through the volatility of 2026. And this is where I share what I call the backbone of the entire Venezuela 2026 strategy, the 60-30-10 capital allocation model. 1. 60%. A stable energy foundation. I place the majority of the portfolio in assets that generate cash flow, benefit directly from the cycle, and are large enough to absorb volatility. Stable energy assets form that foundation. Top oil companies and energy ETFs act like the portfolio's diesel engine. They don't explode upward every day, but they run steadily, powerfully, and reliably. As Venezuela rebuilds and global energy supply chains are rebalanced, this group benefits first and most clearly. Remember, this 60% isn't about getting rich fast. It's about staying in the game. When markets shake, this is what prevents panic selling. Let me ask you, are you building a solid foundation or just chasing the next lucky break? 2. 30%. Growth combined with protection. Next is 30%, where I blend growth with value protection. This is the soft armor that becomes critical in 2026. Gold sits here as insurance. It doesn't need to rise every day. It only needs to do one thing well. Protect your wealth when geopolitics escalate. Alongside it, defense stocks deliver steady cash flow from government budgets and benefit directly from rising global tensions. This 30% keeps the portfolio in rhythm. When energy pulls back, defense supports it. When markets recover, growth returns. It's the balance most individual investors overlook. 3. 10%. Controlled risk for super profits. Finally, and the part that excites most people, the 10% risk allocation. Emphasis on controlled. This is where you allow exposure to asymmetric opportunities, where upside can far exceed downside. Venezuelan bonds and oil option strategies belong here. You're not betting your financial future on them, but you're allowing the portfolio to jump sharply if the favorable scenario unfolds. Ask yourself, if this 10% doubles or triples, how much does it change your entire portfolio? And if it fails, can you still stand firm? If the answer is yes, you're on the right path. Mandatory warning, don't be blind. Let me be blunt. Oil markets never move in straight lines. OPEC Plus can change quotas overnight. China can react forcefully in the South China Sea, triggering psychological and price shocks. These variables can flip the market within days. That's why the 60-30-10 strategy isn't something you set and forget. It requires monitoring, adjustment, and discipline. Without discipline, every formula is meaningless. Before we enter the final section, think about this and leave a comment. If you could keep only one principle in 2026 investing, would it be growth or capital preservation? Because next, I'll bring the entire picture together and tell you when to act and how not to be left outside while the market opens its biggest door in years. At this point, the picture is clear. U.S. financial markets are responding positively and moving ahead of the news. The S&P 500 is bright green, and the Dow Jones keeps setting new highs. Capital doesn't wait for consensus. It moves first quietly and decisively. While most people are still debating political right and wrong, the market has already begun repricing the future. What I want you to remember after this video isn't a specific stock ticker. It's a bias toward action. The Venezuela 2026 opportunity isn't for spectators. It's for those who understand cycles, manage risk, and are willing to deploy capital when probabilities tilt in their favor. So my final message is simple. Open your trading screen today. This is not the time to fear politics. This is the time to turn macro data into real numbers in your account. You don't need to do everything in one day, but you do need to start. A small position today can become the foundation for a major leap in 2026. And tell me in the comments, after this video, will you take action or keep waiting? In the next video, I'll show you how to track large capital flows in real time so you never enter the game too late again.